Mona, let me start with you. What do you think the market's made of all the conflicting information this week?
Yeah, thanks, David. Look, it was almost like a tale of two markets, at least for the first half of the week. Certainly when we got both the CPI and PPI data, as you noted, yes, it did come down from the prior month, but it also remains pretty elevated. Inflation is sticky across the board, both headline and core inflation, probably not coming down as much as investors would have liked to see. But, equity markets actually took this somewhat with a grain of salt. In fact, maybe focusing a little bit more on that better retail sales number. Jobless claims still were very low this week. But bond markets, on the other hand, they had been pricing in this hotter than expected inflation pretty much all week. We saw yields move up. The 10-year and the 2-year were higher this week, almost between 10 and 15 basis points. So a pretty substantial move in 1 week. And of course, we saw Fed funds futures, so market expectations of Fed rate hikes, those started to creep higher as well. So prior to Tuesday's inflation reading, a lot of market participants thought maybe 2 25 basis point rate hikes in the March and May meetings. Now we are seeing an increased probability of a third rate hike in June of 25 basis points as well. That would bring us to a terminal rate of about 5.5%. So clearly bond markets are starting to price in a Fed that could be higher for longer for some time. Equity markets, by the end of the week, they started to catch on as well. Perhaps that message was reinforced by some of the Fed speakers we heard on Thursday afternoon, who even indicated a 50 basis point rate hike may be still on the table. But net, we'd say after a pretty good start to the year, both equity and bond markets may start to see a bit more volatility as we see inflation stickier, a Fed not done, and of course, an economy that's trying to get through it all.
Okay, Rebecca, what do you say? I mean, where are we on the terminal rate? How much of what we're seeing in equities is really driven by the discounting of the value of future earnings?
Yeah, so I think the rise in the discount rate, discounted cash flows, definitely part of the drag on stocks later in the week this week. Both the data, the hot economy, plus the very explicit language from the Fed speakers that it is going to be higher for longer. That was a big part of it. And then if the Fed is really going to get to its goal, 2% inflation, it's going to need to cool down the economy enough to reduce that wage inflation, which means we're also going to be looking at softer earnings ahead. So I think you're going to get one or the other or a combination of both in the months ahead, and that is the downside risk for stocks.
Rebecca, I'm curious, what do you make of this talk on part of Wall Street that there may be no landing, not hard, not soft, that we may actually just tolerate a higher level of inflation for longer and not try to get all the way down? What do you make of that? Is there any plausibility to that?
Almost zero in my mind. I mean, the idea that the Fed is going to tolerate inflation being significantly higher than target for a prolonged period, putting its own credibility at risk, makes zero sense to me. I think the Fed is going to keep tightening until it's confident that inflation is going to get to target. But even more importantly, the market's still pricing in rate cuts in 2024 and beyond. And the Fed is not going to be looking at that until inflation is below target and or the economy has cooled to a degree that the unemployment rate is significantly higher. For those things to happen, you're going to have a lot of economic slowdown, which obviously is going to feed through into earnings.
Well, I must say, Mona, I don't see much evidence of economic slowdown yet. If you look at those retail sales numbers, you look at the labor market, it seems to be really, really tight to this day. So are we close to economic slowdown, Mona?
Yeah, look, with an unemployment rate at 3.4%, that's a multi-decade low. And a recession or even an economic downturn is clearly not imminent. But keep in mind, the labor market historically has been a lagging indicator. And in fact, when you look at some of the leading indicators of the economy, whether it's what we got this morning, Conference Board leading economic indicators, which were negative for the 6th month in a row, or if you look at that yield curve, which has been inverted since mid-July, even things like ISM on the manufacturing side clearly, but even services trending lower, those are more leading indicators of the economy. And of course, the big one, if the Fed is going to continue 2 to 3 more rate hikes, that all has a lag impact on economic growth. And so, yes, the labor market in January gained 500,000 plus jobs. But the question you have to ask yourself is, will that pace of gains be maintained? Can it be maintained over the next, call it 6 to 12 months? In our view, we're probably going to get a softening both in the unemployment rate and those job gains. But importantly for the Fed, we'll probably also see a softening in wage growth as well. That's really where they are looking to for inflation to come down. That non-housing services inflation they've been referencing for the last few months now. They're waiting for wage gains to soften, and they'll continue until they see that likely.
And if I can just jump in, Mona, when I look at what are we going to see in the labor markets? One area that I think gets overlooked a bit is the small business segment. The tech sector, big headlines, but it's 2% of the labor force. Service sector, and a lot of those are small businesses. If you just take hospitality and healthcare, just those two, 26% of the labor force. And the small businesses and the service sector businesses say they still can't get enough workers. So I think the wage pressure is there for the short term, although I agree with you, medium term, I think we will see some deflating. The other thing that I'm watching really carefully is household debt. And one thing that came out this week from the Federal Reserve was a report on Q4, fourth quarter household debt. We had the biggest nominal increase in 20 years. That's both mortgages and credit cards. And credit cards, to me, is the Wile E. Coyote moment. Right now, investors have run down their savings. They're still spending. They're supporting those retail sales by using credit. But that credit debt is quickly rising. And at some point, the rates plus the reduction in incomes as jobs start to dissipate a little bit, that's going to cause us to fall off the cliff, or maybe I should say blow up the balloon.
Yeah, no, that's a great point. And look, the consumer drives the economy, and those credit card numbers are ones to watch because, yes, we've had an excess of savings coming out of the pandemic, but we're seeing that slowly being drawn down. And of course, the next shoe to drop will be, can consumers pay off these credit card bills that they're accumulating? Also keep in mind, and this is just anecdotal, but the tech layoffs we've been seeing, look, technology is a small part of the overall labor economy, but a lot of those have not flown through yet into jobless claims because, of course, there are severance packages. There's a delay in when you actually file the claims, et cetera. So we may start seeing somewhat of a pickup even from the layoff announcements we've seen thus far.